think about when people are in their peak earning years. They're generally in their mid to late 50s, early 60s. I'm making more money then than I've ever made in my life.
Mm-hmm.
And all of a sudden, the IRS comes out with this new rule they call SECURE, right? The SECURE Act. And the acronym actually stands for Setting Every Congressperson Up for Retirement Enhancement, right? Because that act was actually one of the biggest money grabs that I've ever seen Congress pull, and say that it's something totally opposite of what it is. And the reason I bring it up with that person that's in their peak earning years is because that's the person who is the most likely to inherit an IRA from their parents, because their parents are in their 80s.
Yeah.
Okay. Late 70s or late 80s. That's when people start passing away. People think, well, my kids are going to get my IRA. They're not going to be in as high a tax bracket as I am. Well, take a look at the people that are inheriting money. It's not the 15, the 20, and the 30-year-olds. It's the 50 and 60-year-olds that are in their peak earning years. And now all of a sudden with the SECURE Act, all that money is going to be forced out of that IRA at probably the highest tax bracket that there's ever been. And they never would have paid that had they done some proactive tax planning. So I think a lot of people say, well, if I'm going to do tax planning, I got to do it before I retire. No, it's through your entire life you have to do tax planning.
Oh, I completely agree with that. Whatever age you are at, if you are filing a tax return, there is tax planning we can do. Whether you are 18 or 80, now it's going to change over time. No, there's not going to be quite as much I can do with an 18-year-old. I can set them on the right path. But at any point, if you're filing a tax return, absolutely, we can do tax planning. And the SECURE Act's a great example of the power of tax planning, because what you're alluding to, one of the biggest things that it did was force people to have this much shorter time window. When if they inherit an IRA, they've got to distribute it, which means the IRS gets a cut of that. And what I see in practice quite often is that people they'll inherit that IRA, and then they just assume, because no one's told them any better, that, well, I've got to transfer that to a different account, so I've got to distribute the whole thing. And now they've taken an entire lump sum in 1 year, and they pay taxes at the highest possible rates, and they get killed in taxes, absolutely killed. And even though the SECURE Act shortened the window where we have to do that, even within that window, though, we have opportunities to plan if we're being proactive, if we actually have an inherited IRA instead of just taking a huge distribution and paying all the taxes.
Yeah, you're making me chuckle because Ed Slott, a good friend of mine, and I've been studying with him for years. But during our meeting back in the spring of 2022, he went through a private letter ruling where a father died, and I think the wife had already passed, and the two boys inherited the money.
Mm-hmm.
And these two boys happened to be, I think, in their 40s, and there was a couple of $1 million in the IRA. And these two boys immediately wanted to start trading stocks in the IRA. Well, the custodian or the financial institution where the money was held didn't allow stock trading.
Oh no.
Okay. So these boys, not knowing what they're doing, they took the entire $2 million out of the father's IRA, opened up another account, and started trading stocks. And were really surprised that they had to pay taxes on that entire $2 million in that year. And so they filed for a private letter ruling claiming that they didn't know that was going to happen. They thought that they could inherit. There was an IRA. We inherited the IRA. Well, you didn't do it right.
Yeah. The question that you have to ask is, do you have an inherited IRA or did you inherit an IRA? And that might sound like a really small distinction, but this is exactly what we're talking about. Did you get a whole bunch of money? Did you just have an inheritance, or did you actually keep it in an IRA so you've got this 10-year window to do something about it?
And those rules are super strict when it comes to inheriting an IRA. And if you mess one of them up, chances are very rare that you're going to get any kind of sympathy from the IRS, because they say our rules are clear.
Yeah, that's debatable, but that is their opinion.
Yeah,
that their rules are clear, and pleading ignorance does not help anyone. Which is it's a fascinating sort of industry in that the tax code you mentioned, 80,000+ pages, and yet your everyday consumer is expected to be able to file their own taxes and understand all that. It's nonsense.
Right. Well, there's a program.
There's a program. Exactly. If it goes through a software, it must be perfect.
Yeah, there's a program.
Yeah.
But you use a program, but you're a professional looking at all of the different nuances that understand the rules that if you change one thing over here, it could have a more favorable outcome over there. And if you make this mistake, it could have a less favorable outcome. So you're able to play that scenario. And I think that there's a lot of people who have kind of, and some people can use this, all right? The free tax returns, right? You and I were kind of joking about that at dinner last night. And, yes, the tax preparation might be free, but what did it cost you?
Yeah.
And unless all you had was a $30,000 W-2 and you had no dividends, no interest, no IRA contributions, it's fine. Okay. But for somebody who is in their 40s, 50s, 60s, that's accumulating some money, they got, more than just a couple of W-2s, it's time to start getting some professional help.
Yeah, absolutely. I love software, but one of the common myths about taxes that I really try to break down is this idea that, well, if it went through a software, it must be right, because it's just not the case. And I like the software platform that I use; it's a great tool. But to your point, that expertise still needs to be there. And those free platforms. What you'll notice, think back to the last time you used it, or keep this in mind the next time you use it. Most of what they're doing is steering you towards trying to get the biggest refund right now as possible.
Right.
And while refunds might feel good when you get them, that is not how we win against the IRS, because a refund is just the IRS giving you your money back.
Right.
After they took an interest-free loan from you. And it's created this mentality for a lot of taxpayers of, as long as I get a refund, I must be winning. But I've worked with taxpayers who they only focus on, hey, I got a $5,000 refund, I'm doing so great. And then when I say, actually, the IRS kept $80,000 of your hard-earned money last year, and they say, wait, what do you mean I got a $5,000 refund? I said, yeah, because you paid them $85,000 and you only owed them $80,000. And they just, a lot of people have no concept for how much of their money the IRS is actually keeping.
You know what would cure that? Is if you had to actually write the IRS a check every month, just like you do with your mortgage or your health insurance or whatever. You got to write that check every month. That would change everybody's attitude when it comes to taxes. In retirement, guess what happens? You're writing that check every quarter. You're estimating what you're going to owe. You're seeing it. You're saying, I got $1 million in my IRA. No, you don't. You don't have $1 million. Yeah. Well, no, look at my statement. Well, yeah, your statement says you have $1 million, but you have a partner in that account. That partner's Uncle Sam. Go try to take that $1 million and go spend it. You can't spend $1 million because it's not all yours.
Starting your route to retirement.